Welcome, everyone. I'm here with Savannah Kelley. Today, we're going to talk about U.S. consumer spending and a bit of a global lens. Savannah, do you want to kick us off?
Yeah, absolutely. Talking about consumer spending in general, so it's like 68% of the US GDP, which is interesting because that compares differently across like country to country. But I also wanted to mention from a lens of time span as well, like it's interesting to analyze it that way because I think the key here is to look at it in 5 to 10 year horizons instead of year to year, because when you're looking at it, sector to sector, like think like education, health, infrastructure, when you're building roads, it takes a while. Like it takes a while for that infrastructure to be input into those countries and for it to make an actual impact. So if you're looking at it year to year, I don't think that the analysis is really correct. So really, it should be looking at it on like a 5 to 10 year horizon, which is interesting. But comparing it globally, so of course, like the U.S. has a $28 trillion economy. If you compare it to something like Germany, which has a $4.5 trillion economy, the U.S. only has like 15% of that as housing. And like I said, 68% is consumer spending. But when you look at someone like Germany, 25% is manufacturing for them. And for us, it's much less. It's more like 11% for the US. So looking at it from a global lens, it's just different from country to country where those allocations are. In general, like the US economy it's steady but cautious spending. Like if you think about what happened when we talked about the port strikes last week, there was a lot more people buying things and like consumer spending went up pretty greatly because people were stocking up for the port strikes, thinking that something was gonna like happen over time. Thankfully, like that's stalled a bit on this end, but it could have been worse than it was. But in general, just looking at everything too, like the trade deficits, interest rates, and even like public debt, they should be thinking about the broader categories and long-term growth, like the 5 to 10 year lens, like I mentioned earlier, versus year over year. So I think that there's just a shifting in lens here. But just in general, it's interesting to see like where consumer spending is higher in the US and like where things like housing and like just different countries like China and Germany are like spending in those buckets. So definitely interesting, but good to look at it from a different lens.
Yeah, I love it. I think it's super critical. What you're saying is exactly. A lot of people are missing that lens, right? Like a lot of people are not looking at a country as a long-term lens. They are looking at it in terms of just, what's going to happen over the next 6 months or a year. But if you look at a country like a larger company in a sense, right? Like if you're going to go launch a company and do lemonade, you can make investments in this hour and get results in the next hour. You can make investments today to get results next week in smaller companies. And then as you grow your company, you're going to make investments in a month or in a quarter that's going to result in the next month or the next quarter. In a larger company, it's going to be invest in this year to get next year. For a country, there's not going to be these daily things, these weekly, these monthly things. The short-term version for a country is let me invest in something this year, maybe a quarter on an interest rate, and then get something next year, right? So they're going to be thinking in 5 year time horizons and then in their longer term version, because there's going to be short, medium, and long term investment horizons for a company and short, medium, and long term for a country, right? And so we want to look at the country because when we analyze something like interest rates, when we analyze something like US consumer spending or any country consumer spending or any country's GDP, we want to look at it from the broadest lens of how do you grow a country. US GDP growing between 2.2 and 2.7 as like a nice home base on GDP growth versus India and China usually hovering around 4 to 6%, much higher. And a lot of people just say, oh, they're growing better than the US. And it's like, you have to look at these as like 10, 20 year time horizons. Three to 5 is the more, like you're saying, the more appropriate and relative, but a lot of things are long term, right? And so we want to look at it from that perspective. If you want to take a 477 billion Nigeria or a 300-ish billion Denmark or a 250 billion-ish Finland and country, and you want to say, hey, let's grow this one, right? You look at it from the productivity of citizen base, right? So you have things like the US having 62% labor force participation, right? And you look at things like then within this lens, right, of employees being productively engaged, since say like in the US, 52% of income for the US to get you to that $4 to $5 trillion in income, depending on which year you're looking at in the last few years. 52% of that is coming from taxes, right? So you need labor force participation. You need productive companies to do that. And then you look at the 1.1 to $1.5 trillion debt that we're looking at because we're doing a lot of spending. You look at the biggest spending areas, it's Social Security. Then military is way down below, and a lot of people want to talk about military all the time. We want to be able to look in terms of like how productively engaged over the short term and long term are we doing this for the citizens, right? So then, like you're saying, we look at things like education, which is going to be a long-term thing, but we care about education. We care about the health. However you want to execute health, right? There's different political sides that will execute health differently, but however you want to execute health matters for keeping people productively engaged. And then, so if you look broadly, you go health, you go education, military just to defend against, whatever your value system is for as a country. And then you look and say, what is these short-term business cycle things? The interest rate comes in really, really powerfully here, right? Because as you raise the interest rate, debt is going to be more expensive for companies, which means they have to make more diligent decisions. And this is important, right? We've had the interest rate higher for the last 4 years. We just started lowering it. It's a normal cycle. That is one of the things that a government can do to a country is say, look, in a company, you might be saying, I want to grow. I think I'm going to put a bet on this product or on this service, and I think this one's going to grow. But maybe you're wrong, right? You're going to be more diligent if money is more expensive to come by. And so money is more expensive when we raise the interest rate, right? We're talking to a variety audience. So some of these things, very basic, easy to understand. The comprehensiveness is not talked about enough by everyone. And for people that are not familiar with this is very easy to just understand. The country is going through long-term investment and reaping cycles. And when you, and one form of looking at a country's investment is when you raise that interest rate, to make companies have to make more diligent decisions, you start to realize that in every single recession, low period in the economy, we've always had some of the best companies come out of those because that's where diligent decisions are made. And when those diligent decisions are made and those diligent investments, those much more rigorous product and service and people investments in those periods are made, then when the interest rates are lowered and debt is easier to get and the country and the companies flow easier, then what happens is that money is used to accelerate something that was diligently made as opposed to free and easy money spent on lots of different things that maybe you weren't so sure about. And so this is the lens we really want to be looking at consumer spending with and interest rates with is under what broad initiative is the country growing this economy? Is it labor force participation? Is it more diligent decision making, and how is that going to cascade down to making companies have to make more diligent decisions on the products and services they do and on the interview questions of the people that they hire?
Yeah, absolutely. That's why this is so important to view it from a global lens too, because you're right, like the latency is different depending on what you're focusing on. Because I mean, if you're focusing on something that takes quite a bit longer, like a 5 to 10 year horizon for the country, like infrastructure, that like if the country is investing a ton into infrastructure, then it's going to have a lot more latency and the effects on its GDP than the other countries would. That's focusing on other sectors that might have like a shorter implementation cycle and effects to their GDP in general. So completely agree to viewing this on a global lens and being fair in the comparisons, like country to country, year over year, and in those like time horizons, like the longer time horizons, is what we should be looking at rather than comparing just year to year short-term wins for these countries, because you're right, like they need to be compared as if they were companies, because countries in general, like it can be greatly compared as running them just like companies because of, implementing like a ton of money into healthcare. Like you could see in the same way as a company, if you implemented a ton of money into sales, it's kind of the same perspective, but just a good comparison there to see the growth cycles and like how long it's going to take, and also like which levers that those countries are pulling to affect their GDP and like how that's going to be affected.
Yeah, and I think it's important for the people that are not realizing that there's people that realize we're on we are on debt cycles, we are on interest rate cycles. There's going to be several years at a time up, several years at a time down. There are people that realize that, there are people that don't. But the nuances, whenever people decide, are we about to go into a recession, are we not? There's nuances between, is it going to happen in this 6-month period or this year period? And there's questionable periods across a 12 to 18 to 24 month horizon. But it's not questionable about which like rough 3 to 5 year block are we having a down period and having an up period, because that's exactly the mechanisms that we are always continually doing, and that is what we have historically seen. The last thing I'll say in the last like 10 or 20 seconds of the video is like, even when you look at it from a war lens, when people want to start talking about rumoring World War III kind of things, we're not going to have a massive world war because every country is so interdependent. When they start to battle in a big way against another country, it's going to affect their own economy, even if it's like you affect one country which affects the other one. As soon as we had Russia and Ukraine and wheat prices and all the other exports change, the markets change, it has a cascading effect every time oil prices change. And we have massive cascading effects even when we're not in some sort of war situation. We're not ever going to have a big war, a big world war. Whenever people want to do wars, it's only going to ever be able to be some sort of micro thing. So thank you today for chatting, Savannah.
Thanks, Jeremy. It's great.